So what's the Dow theory? Well, first of all, you have to know the Dow theory is superior to other trend following strategies, and I will prove it with data. It's not just an assertion. I say, oh, it's superior. No, no. In the next slides, I'm going to show you why it is superior and with numbers. What I said before, moving average, rate of change, breakout systems do a poor job at outperforming buy and hold and cutting drawdowns, because this is an important thing. Most investors get obsessed with outperforming, but the first thing you have to do, no matter whether you are a fundamentalist, technical, whatever you do, is to cut losses short. So first of all, if you want to outperform, first of all, you have to cut your drawdowns. You have to cut your losses. Because if you don't manage to keep them contained, then you will never be a successful trader. This is very clear. I know it's all traders say the same, keep your losses, cut your losses short, but this is really very important, and it can never be too overemphasized. So why the Dow theory is superior? I said, okay, it's better than moving averages, breakout systems. I think because if I have to narrow down to two aspects, is because first of all, it has non-parametric nature, and because there is the principle of confirmation. I explain the two. First, it has a non-parametric nature. What does this mean? If you're doing trend following with moving averages, breakout systems, rate of change, basically you are toying with parameters. So you're saying, okay, I'm going to trade at 200-day moving average, or if it's a breakout system, I'm going to buy when there is a 40 days breakup, or a 20 days breakdown, I'm going to sell. But if you look at it, you are doing, it is parameter dependent. So you need a parameter, 20 days moving average, 200 days moving average. And there is, well, this is more in the realm of a science, but there is science that shows that parametric depending, not only trend following systems, everything in life tends to be what is said in English, cherry pick. So it tends to underperform in real life because, okay, maybe a 200 days moving average parameter worked well in the past, but not necessarily is the best parameter when looking into the future. So the Dow theory is not parameter dependent because we use the concept of secondary reaction. It looks a little bit, but basically we just need to single out important pivots, as you can read in the slide. There are important pivots, and these pivots are really important points on the chart. So it doesn't. It has nothing to do with a 200 days moving average, a 20 days breakout. It's really important pullbacks, important rallies. And these are the relevant points we pay attention for a break up or a breakdown. We could say that, of course, the Dow theory is more closely related to a breakout system, because we pay attention to important points on the chart. But unlike a breakout system, we are not buying a 20 days or 40 days breakup. It depends. Are the important pivots on a chart? So this makes us a very robust system. Furthermore, the Dow theory has the principle of confirmation, which means that even if there is an important pivot on the S&P 500 and it is broken up, we will not be buying unless, for instance, the industrials or other index is confirming. So the principle of confirmation is very important because it weeds out lots of noise. So there are lots of false breakups. Even by selecting important pivots, sometimes you can have a false breakout. So by using the principle of confirmation and requesting that, for instance, an important pivot is breaking out both, for instance, on the Dow Industrials and also the transportation, you without noise, and you increase the efficacy of your signal. And furthermore, the Dow theory can be applied to any market that trends. So it's not limited to stocks, so it can be applied to gold, silver, as we will see in the next slides. Okay. I told you before that the Dow theory works in many markets, the Dow theory outperforms buy and hold. But of course, here the proof of the cake is in the eating. So I compiled some statistics derived from my blog. I've been blogging since 2012, so I have quite a lot of data. And you can see, for instance, the Dow Industrials, you can see here, and below, you see the horizontal chart, has had more than 3% outperformance on an annual basis versus buy and hold. You will see, wow, this is not that much. Watch out. The Dow Theory has on average one trade per year. So when you just trade once a year and you achieve 3% outperformance versus buy and hold, this means that this shows the incredible accuracy of the Dow Theory. Because you can say, oh, I know of a trading system that makes 10% outperformance. Okay, but then you are trading every 2-3 weeks. So maybe you get 50 trades or 60 trades per year. So with only one trade on average per year outperforming 3%, it's really an extremely great outperformance. Okay, I told you in another episode that it can be applied to many markets. For instance, here I apply it to the pair USO XLA, which is energy, oil, ETFs. And you can see that there was an outperformance of around 1.5% versus buy and hold. As a reminder, during the period starting from 2012, there was a huge bear market. So in oil. So it's a proof that it's really very accurate, the Dow Theory, in getting rid of the bad times and profiting when there are the good times. Well, if you look at GDX and SIL, which is the gold and silver miners ETFs, is really, the Theory really did wonders because we achieve an outperformance north of 5% per annum, which is really unbelievable. And when we look at the drawdown reduction in the next slide, you will see that this is also unbelievable. With gold and silver, gold is really a very treacherous market. It's not a very good market for trend following, but nonetheless, we managed to make more or less 0.7% outperformance versus buy and hold. So even when dealing with a treacherous market, we managed to do better than buy and hold. And with TLT, we also managed to make almost 2.5% outperformance versus buy and hold. TLT is the long-term bond ETF. So it also works at Dow Theory with interest rates. Well, furthermore, it works very well with interest rates because it's a very trendy market. So it works very well. So now let's take a look at drawdown reduction. As I said before, investors get obsessed. Oh, yes, outperformance. No, first of all, good defense. The good offense is a good defense. So first of all, you have to reduce drawdowns. And then, okay, reduce drawdowns, and afterwards, you will look for outperformance. Okay, so the Dow Theory versus buy and hold. This is the estimated drawdown reduction versus buy and hold from the same database. The Dow Industrials had a 50% drawdown reduction. So it means if in that period, the Dow Industrials, for instance, had a maximum loss of 50%, we only had 25%. And this is, in 2008, the stock market went down by more than 50%, 55% for the S&P. And under the Dow Theory, we had a drawdown just half. Nonetheless, we lost 25%, but it's not the same of losing 55% than losing 25%. Well, if you look, it's really, I didn't make up the data, so it is not fake, but this is the results I got. If you take the energy USO and XLE, the oil ETFs, drawdown reduction was more than 90%. It is one like that. It's unbelievable, but so it was an incredible drawdown reduction. Why? Because during that period, energy was in a very deep bear market. And the Dow Theory, the deeper the bear market, the more drawdown we cut. So this is the living proof. With GDX and SIL, the gold and silver miners ETF, you see that we reach a drawdown reduction around 50%. So our loss was half the loss made by buy and hold. With gold and silver, if you remember the previous slide, our outperformance was very muted, but we did outperform. Not much, but we did. But when it comes to drawdown reduction, look at gold and silver here, it was more than 50% drawdown reduction. Okay, so we didn't manage to outperform that much, But even with a treacherous market, because it's a very tricky market, we cut our maximum loss by more than 0.5%. So, which shows once again that the Dow theory works. Because furthermore, if you do this with a moving average or a breakout system with other systems, you will reduce drawdowns, but not as much. And forget outperformance, by the way. And with TLT, you see that we reduce drawdowns by almost 60%. So unbelievable, the drawdown reduction. So if you couple substantial drawdown reduction with outperformance with just one trade a year, we can conclude that the Dow theory is, in my opinion, is the best trend following system in our time frame. So if you want to make on average one trade per year, so this is not day trading, so it's really relaxed, I think you cannot get any better with other trend following systems. It is the Dow theory. And I repeat, maybe I will repeat myself, and there is a why. And the why is because it has non-parametric nature, as I explained in another episode, and also because only relevant pivots matter. We are not just taking a 20 days breakup. No, we only take relevant pivots and we require confirmation. And this makes it a very, very powerful trend following system. Okay, the Dow theory, as I have shown in previous slides, can be applied to many markets, but not also to many markets, but also in several time frames. You can apply it to weekly bars, daily bars, and also, if you are young and have lots of energy, to minute bars, because the principles are the same. You single out relevant pivots, you require confirmation, and it works. I did some tests with minute bars, and it works. I didn't do it in my practical trading because I cherish my quality of life, and I don't want to be glued to the screen all day. But if you're young and with good disposition, you can apply it to minute bars, and of course, then your drawdowns would be even more reduced, and very probably you will achieve even more of performance. But everything has a price in life, and I'm not willing to pay that price. But it works. This is important. I did some tests in the past, and it works. It works in any time frame: daily bars, minute bars, weekly bars. I use weekly bars as an aside in order to determine the secular trend. People sometimes talk about the cyclical bull market, and also there are secular bull markets. So when I want to take the very, very, very long-term term, 3, 4, 5, 7 years, I use weekly bars. And this is not stressful because, of course, you get very few signals. But it gives you also a perspective of really a very long-term trend, and it also works. Okay, you can also apply the Dow theory as a trend filter for your short-term trading. I have been doing that for many years. So I had several swing trading systems, short-term trading systems, but I only took trades when the Dow theory on the longer term time frame was in a bullish mode. So it was up. So I said, okay, I'm going to buy a dip. For instance, sometimes I was buying dips, provided the long-term trend is up. And if the long-term trend is down, then I was not buying the dip. So this is one of the applications which I was doing in the past. Now I don't do it because I value, once again, my time, and it requires really at least 2 hours a day, and I don't have that time. But it was a very nice way. I had a maximum drawdown around 15%, which is a very reduced drawdown. And without leverage, I was making around 18% per year. So the Dow theory works very well if you apply it to short-term trading, just as a trend following filter, not as the main signal, but just to know when to buy and when not to buy. And also it works if there are families in the investing world, people that say, no, I'm a value investor, I want to buy value. Others say, no, forget value. You have to buy the new technology. This is the future of humanity. So I'm a growth investor. Well, it works with both. You can use it also as a filter. Okay, you can be a growth investor, a value investor, but if the trend of the market is down, it's not the right moment to buy. And this is one thing I should nail down on your heads. If the major trend of the market, the S&P, the Dow Industrial, is going down, forget value, forget growth, because all stocks go down. Okay, some more than others, but you have a a headwind against you, and this headwind will make you fail, or maybe you will underperform. You will. It's not so. You always have to trade with a long-term trend. No, I'm a growth investor, Netflix, whatever. It's okay, but trade with a long-term trend, as determined by the Dow Theory.